welcome to this Fireside chat hosted by TreasuryONE ETM Analytics. This morning we're going to do it a bit differently. Normally we do a nice presentation to everybody. We thought we're going to mix up things again this morning by just having a chat about what's happening in the markets, getting different opinions. Today our chat will be moderated by Ilse Marie Leroux from ETM Analytics. She's got a bit more knowledge about moderating debates like this than myself. Again, Maria's just posted on the right-hand side for this chat. Any questions, please post on the right-hand side. We'll chat about it and continue to get to it as we go on with this Fireside chat. But I'm going to hand over to Ilse Marie to take it away first.
Morning, everyone. Thanks, Vichard, and thank you for joining us for this webinar. I'm joined obviously by George Glenhouse as well, Head of Research and Director at ETM Analytics, and TreasuryONE's Andre Salia, Currency Risk Strategist. So it is the webinar for navigating recent rand volatility. We're looking at central bank strategies and a global recession, whether, is there reason for concern? So it is a lot to get through, and there's a lot going on in markets at the moment, and I think it's difficult to sometimes just get a grip on everything and how everything fits together. So I thought it may be best to start with local matters, and I know, George, you recently sat in a meeting with the South African Reserve Bank after they decided to pause on a rate hike. So it was a bit of a cautious pause, but what are some of the things that is keeping Kganyago still awake about the medium future?
Yeah, I think you're right to call it a cautious pause because they are concerned. They still see the outlook for South Africa as quite a fragile one. We've gotten ourselves to a point where inflation's coming down. That's good. Where the rand thankfully recovered, that's also good. But the overriding concern that they have at the moment is around fiscal issues. So they are particularly concerned about the unfunded liabilities that sit off the government finance figures that we read about at the moment. So we're talking about things like municipal debt, for example, that doesn't form part of government finance stats. We're talking about the bailouts for the SOEs. We've just seen at the beginning of the year how they announced a huge package for Eskom. All of this gets tacked onto the government balance sheet. And as we go on, the more the debt pile increases, the bigger the risk is to the fiscus, because obviously you have to fund that debt. You've got to run that debt. Not only do you have to raise the capital to plug the fiscal hole, but you also incur increasing debt finance charges, and that is unfortunately a factor that increases the risk profile of the country, and as a result of that, it renders the rand more vulnerable to bouts of sell-off, and they are concerned that we could see another aggressive bout of rand weakening, which undermines their efforts on inflation and then forces them to go and increase interest rates one more time when they clearly don't want to. They are not blind to the fact that the economy is struggling with growth at the moment, but at the same time, they know that allowing a rand to free fall is not in the country's best interest and can undermine the efforts of the authorities, both in government and the Reserve Bank, to try and foster a more stable growth environment that generates better growth conditions.
Like I said, George, the rand has been extremely volatile and been swinging all over the place since the start of the year. I think it's been trading between 17 rand and 20 rand, for the greater part of the year. And I know it's difficult to look into a crystal ball and ask, what will the rand do over the next 6 months, because we just don't know. But Andre, I would like to ask you just, what are some of the factors that could sway the rand in a certain direction that we need to be looking out for at least over the next 6 months?
Well, I think some of the factors is most definitely interest rates in America and what the Federal Reserve is going to do. Also, what happens in South Africa in terms of elections coming up and the turmoil or the possible turmoil around that. As George mentioned that, he mentioned interest rates in South Africa, fiscal discipline and fiscal chaos within the South African government. We have to look carefully at what happens at the BRICS summit coming up. I see that we now have invited Iran as well. So we keep siding with the wrong people in this country. Keep on saying that we're siding not with the West nor with the Russian side, but our action speaks a little bit louder than what our words are saying. So, those are all things that gets thrown into the pot. Load shedding is definitely not on the back stages. We're not quite sure whether there's a little disaster waiting for us going forward. We still don't really know when Coburg's really going to come back online fully. So load shedding is still an issue, and the impact of that on the economy as such. So those are just some of the factors that we throw into the pot as factors influencing the rand going forward.
And we know these factors aren't going to go away overnight, and we have seen some criticism towards the SARB for raising interest rates. Like George said, we understand that the economy is struggling. We understand that demand is not great. So, do you think there's still, Andre? Do you think there's still space for the Reserve Bank to up rates further, despite these criticisms that's been thrown at it?
Despite the criticism thrown against it, yes, but I don't think that they were wrong in not moving interest rates at the previous move. And if I look at my statistical data here, based on month-to-month figures, then the back-end figure that falls out during the release of the next inflation figure coming out is a massive 1.5%. So, we're likely in for a further decline in inflation rates at the release of the next round of inflation data. So I think that's one of the reasons why the Reserve Bank said, just hold off a little bit and don't increase right now, because we might have a little bit of mud on our face having a decline in inflation just before the release. And then in the month going forward, we might see another decline, but thereafter things changes. And it's those very month-on-month figures that changes in the US as well. And the back-end figure at the next release that falls out for them is actually a negative figure. And their month-on-month figures is not quite adding up to the 2% inflation target. As a matter of fact, we might see a bit of an increase in the next release of inflation data out of the US. And I think that's where the second round of inflation that everybody so kindly speak of might start coming in and put even more pressure on the Federal Reserve to keep interest rates high, most probably come in with another interest rate increase going forward. And therefore, we will have to watch closely what happens in South Africa as to whether we get a second round in inflation. And we know that the cost of doing business in this country is not easy, and that's all filtering through in price increases to the consumer. So I think the Reserve Bank has got room for another interest rate increase, and they will certainly do so if necessary. And we can't keep on making this gap between ourselves and the US smaller and smaller and smaller, because that will have an impact on our capital inflows.
George, how big is the risk of the second round of inflationary pressures coming through, for interest rates going forward?
There certainly is a risk that inflation stalls in its downward trajectory over the next few months. But if one has a look at the money supply figures, especially on the private sector credit extension data, we can see that the growth in private sector credit extension is moderating more rapidly now. So that's a very clear sign that the credit cycle is tightening. And as a result of that tighter credit cycle, we do know that tends to be more disinflationary than inflationary. In other words, the effects of tighter monetary policy are working, and there is less monetary space for inflation to take hold. So we think that over the medium term, and by that I'm talking over the next, call it 6 to 12 months, we would expect to see inflation moderate further. So I think we're very close to the top of the rate cycle, if not at the top already. The big unknown is the uncertainty that prevails. And so, you've got the taxi strikes that are unfolding at the moment. They have turned violent. It doesn't do much for the optics of South Africa to the rest of the world, especially when you've got the likes of Elon Musk talking about genocides in response to Julius Malema's kill the Boer comments and the like. It's the optics towards South Africa remain poor, and they're unlikely to improve, at least on the political front in the run-up to the elections. You'll probably find that the political rhetoric hardens and it becomes more inflammatory than it is at the moment. So we need to be mindful that that is going to be a feature going forward. One of the potential saving graces for South Africa and the rand is the fact that the dollar itself is quite overvalued. So if you have a look at the dollar on a long-term basis, and I'm talking data going all the way back to the 60s, if not before that, you'll find that the dollar is still quite at very expensive levels. So on a trade-weighted basis, it is strong. And unjustifiably so if one considers their budget deficit. So their budget deficit is worrying. It's clearly worried Fitch because Fitch downgraded them. And the net result is that we've got a dollar that's starting to look fiscally fragile. And the minute you have the central bank, the Federal Reserve, looking to potentially reduce interest rates in the future, you no longer have that protection of attractive interest rates to support the dollar. In fact, if those bond yields start to come down, we can see a dollar correcting weaker, and that might help support the rand, at the very least, prevent it from going through another major wobble. So these are some of the factors that we need to consider. But South Africa is a master at scoring own goals. If we could just get things like the load shedding under some measure of control, if we could just run our SOEs a little bit better and just enhance fiscal discipline such that we're not worried about the country's sustainability going forward, that would make a huge difference. There's a tremendous risk premium built into South African assets as a result of all of these things. And if you could just remove some of that, you'd probably be taking off at least $1.50 to the dollar off the current rate. So that's the price we're paying at the moment for the maladministration and the ineptitude of government. And unfortunately, the burden, as always, falls on the tax base and those that can least afford to hedge themselves against this country, being the poor. So, it shows up in frustrations, riots, protests, and the like. Social upheaval is very much a byproduct and a symptom of an economy that's not being run well. And so, that's what we're living at the moment. And so, to Andre's point, there's a lot of uncertainty in the system right now. It's not clear cut what the path is going to be towards lower interest rates, whether we're at the top or whether we have one more to go. But quite clearly, the economy is under strain. And if I were a betting man, I'd probably say 60-40 or 70-30 in favor of us having reached the top and coming back down. But, the big caveat is whether we can prevent the rand from blowing off.
George, I just want to quickly come in here as well. So, but if you continue to look at US data that comes out, US non-farm payrolls, IDP numbers, unemployment, all the data out of the US, everybody's talking about recessionary worldwide, and you see it, the German figures, the European economy is struggling, UK economy is struggling, but the US seems to be at 21-year highs on interest rates, but the data just continues to surprise to the top side, and the economy is strong, and it looks like Jerome Powell and the Federal Reserve is going to manufacture this soft landing in the recessionary environment that everybody's talking about. Although the inverted yield curve has been sitting there for better part of 14, 15 months, that the short end is higher than the longer end, they continue to print money. The futures downgraded, like you just said, they downgraded them because of the debt burden that they've got. And imagine you're at 5.25%, where they currently is they're paying astronomical amounts of interest on their debt that they're issuing, but still they're issuing debt. Yields continue to rise. So I know you speak about the top of the cycle is here, and probably can be the top of the cycle, but the rates seems to be they're more than happy to stay here at 5.25 for well into 2024. And all the cuts that was priced into the beginning of the year it's on the back burner now. What is your take? I just mentioned, what's your take on that front?
Yeah, Vichard, I think we need to just be a little bit patient. There were some massive forces that were injected into the system through the pandemic. We're talking about just the US alone. You're talking about $5 trillion worth of QE that was pumped into that economy in just 18 months. That is just a colossal amount of funding. And what we've seen post the pandemic is, sure, the Federal Reserve has has jacked up interest rates and has conducted some quantitative tightening, in other words, undoing some of the quantitative easing, but not to the same extent that they pumped it in the first place. So there's still a hangover effect of the stimulus that was applied back then. But arguably more importantly, what we're seeing at the moment is the US government is running an enormous budget deficit of around about 5.5%. Budget deficit to GDP ratio. It means that their debt pile is growing, despite the fact that they are one of the fastest growing developed market economies in the world. Their debt pile is growing even faster, and hence what we saw with regards to Fitch. So Fitch has downgraded them because they see the fiscal trajectory that the US is on as unsustainable. Now, there were some comments from Ray Dalio, who's a famous US hedge fund trader in America, who pointed out that what's going on at the moment vis-a-vis the fiscal stimulation that's currently taking place is that it's propping something up that otherwise wouldn't be sustained on its own. So what he's effectively saying is that the burden of stimulating the economy has shifted from the Federal Reserve across to the US government, and it's coming at a cost. And I'm not so sure that the cost is going to be worthwhile. So the data for the time being is propped up and looks better than it otherwise would. But it too is going to have to be tackled. If I looked at the Congressional Budget Office data over the weekend, and I was very interested to see that even the Congressional Budget Office is talking about their budget deficits deteriorating, not improving. So the situation in the US, unless they implement some form of austerity, is actually going to get worse, not better. And I think it starts to weigh on the dollar eventually. On the economic front, we must be very careful not to place too much emphasis on some of the lagging indicators, such as the labor market data. If you instead focus on things like house prices, which have just started to decline, if you have a look at your mortgage-backed association buying index of property, you'll find that it's at multi-decadal lows. You'll find that the leading indicators in the US have fallen and fallen quite a bit. You'll find that the probability, the Fed's own measure of a probability of recession, has increased to the highest level since the financial crisis. So there are indicators that are showing that stress in the US is building. But I think we are in this peculiar situation where you still got the remnants of some of the stimulation applied during COVID, just because it was so enormous, that still sits inherently in the system. And on top of that, you've also got the government that has not scaled back on its expenditure, even though its tax revenues cannot match the expenditure growth. So at some point, they're going to have to rein in some of that expenditure. And at some point, they're going to have to either rein in expenditure or raise taxes. Either way, you're talking about some sort of an austerity event that will eventually happen. And that in itself is just going to compound what the Fed has already done. So I'm far from convinced that the US is going to get this soft landing. It looks that way at the moment. And admittedly, they've been able to keep this Goldilocks kind of environment afloat for longer than most of us anticipated, but they are throwing an enormous amount of stimulus at the problem, and that stimulus, even for the US, is unsustainable. So I think we need to be careful about just looking too close at the here and now and focus rather on the broader cycle. Recall also that because you mentioned the US yield curve and how inverted it is, and it's been done here for quite a while. You're quite right. It has been done here for quite a while. The real problem is when the yield curve starts steepening. That's when you start seeing the data in the US economy deteriorating rapidly. So at the point where we start seeing that US yield curve going back into steepening formation, it's probably going to be because the short end of the yield curve is starting to come under pressure. That's probably going to be as a result of the Fed signaling that it's got to cut rates. And that's probably going to come attached to some pretty bad data that's going to come through. So for now, we're living through this Goldilocks period, but I don't suspect it's going to be around for very long. And perhaps we overestimated or rather underestimated the US government's ability to keep things propped up. But it'll catch up with them eventually. It always does. And this cycle too will turn. The credit cycle in America has changed. Their money supply is contracting at 7% year on year at the moment. That is a colossal contraction for an economy that size, and it's got to have implications for asset prices. And I think, like I said, we just need to be patient. The cycle will turn. US Treasury yields will drop, and people will lose a little bit of faith in what's going on in America because at that point in time, just remember that they've already tapped into their fiscal space. From a budget deficit of 5 and 6%, you would really need them to start running budget deficits of 10% if they were going to apply a lot of fiscal support to help that economy. And that in itself is unsustainable without massive quantities of QE, which historically haven't always been very positive for the dollar. So I'm still of the view that the dollar is expensive. If I were a betting man, I'd still bet on the dollar coming off. But we may need to be patient, and that's clearly the signal that we're getting at the moment.
George, I hear what you say, and I'm not going to disagree with what you say, but if we look at that, and we look at an American economy that might be going for a hard landing, and we look across the globe and we look towards China, which is also not really coming out and showing real massive growth of any kind. As a matter of fact, nowhere in the world is that really happening. And if the biggest world economy then goes into a bit of a slump because it's a hard landing, that will have an impact, in my opinion, on world growth. That will have an impact on commodity prices. And yes, we might see a dollar weakening and a rand benefiting from that. But ultimately, that would be, in my opinion, quite disastrous for South Africa that needs growth. And if we go into a world economy that goes into a further slump, not showing any real growth, then especially going into elections and so forth, is not really going to get us anywhere that's putting us in a good space. Would you agree with that?
Yeah. I mean, the weaker dollar view is just that. It's a weaker dollar view, and it offers a little bit of respite. But, you know, as I mentioned earlier, yes, we still have the elections, which are concerning. Equally, the big caveat is if you do get a US falling over, you'll get a rise in overall levels of risk aversion. You are going to see rotation away from riskier investment destinations. Emerging markets do fall into that, but you get leads and lags with a lot of these things. Initially, what you'll probably find is the US not falling over dramatically. You will probably find also, just bear in mind, we've got central banks now that are not scared to delve back into QE. So, you know, the perception out there is that the risk of a huge recession stroke depression is no longer there because the central banks kind of backstop everything. But you know, that aside, could we still have a financial market wobble? Absolutely. But in the run up to that financial market wobble, you'll probably find that there will be a period whereby the dollar still gets to weaken and financial markets aren't responding negatively. In fact, you've had a little bit of a taste of that now recently through the past week, when on Friday we had the payroll data coming out of America, which was mixed at best. I think it was a little, I would probably classify it more softer than not, mixed at best, and the stock market jumped. The stock market rallied in response to that because people were feeling a little happier about the fact that the Fed might not hike again. So you go through these weird periods where, you know, things don't necessarily always make sense at face value, but at the moment we're in this weird phase where bad news out of the US economy is ultimately good news for the financial markets, which ultimately means there's some respite on the risk appetite front, which is the window, and I'm calling it just a window of opportunity where the rand can have to stage a mini recovery before, you know, the fallover scenario. The fallover scenario is when all bets are off. That's when you can get a tremendous amount of volatility that follows. So, you know, I'm not at all, and I want people to understand this very clearly. I'm not talking about from here on out a rand recovers. Not at all. The dollar might weaken, sure, but the rand's going to have its own idiosyncratic issues that it's got to deal with. I do think that there will be a window for the rand to recover, and I suspect that it still happens before the end of the year. But I would caution people not to expect that to be a long-lasting thing, and that for importers in particular, if that does materialize, utilize the opportunity as it presents itself. Jump in and try and cover forward, because there is trouble brewing. And the trouble that's brewing, I think you put it quite nicely there, Andre, is that it can cause a lot of volatility, and that volatility can undo, and it can happen quickly. And we've just seen the rand lose over a rand to the dollar in the last week and a half. It, again, happened very quickly. That's what the rand does. So, you know, when the opportunities arise, take advantage of them, because they may not be around indefinitely.
Thanks, George. We are running out of time, and Andre, I think I just want to ask you this question that came in from Peter. There's been concern about the growing current account deficit, as well as the impact of the slowing commodity cycle that's been made worse by South Africa's logistical issues. You know, the trains not working, the ports being stuck. Is the support for the ZAR eroded?
Is that for me or Andre?
Andre, sorry.
Okay, so if we look at, I think that's with, if I go back to where I started with everything that gets thrown into a basket that could influence the rand, then a growing current account deficit is just one of those things. And the factors contributing to that, low commodity prices, even if the commodity prices are fairly high, you can still not get your goods to the harbors. You cannot get it to be exported properly. The impact of that on doing business. That's just one of the other factors that Peter is throwing in here and asking the question that gets thrown into the basket is a declining current account deficit. Now, if we do get low growth in the world, and we do import less, then we might see that also start changing, because then on your trade balance you might be looking a better, you know. So there's a lot of things that plays into the hands of whether there's support for the rand or not. At this point in time, I would say there's very little support because of our own doings and our own wrongdoings in the country. It can be changed. But at this point in time, certainly doesn't look really fantastically good. And logistical problems doesn't add anything to the assistance of changing that.
I just want to quickly...
If I can also just jump in there, there's another factor that we actually haven't spoken of yet, but which has played a very significant role this year. And that is, well, it actually started last year with the authorities changing the regulations governing fund managers, allowing them to take up to 45% abroad. I saw data presented to me just a week ago that showed how many of the fund managers, excuse me, had taken full advantage to rotate abroad. Not only was it a function of the delistings that that are happening on the JSE and the weaker growth prospects domestically, but they felt that there was enough risk baked into the system domestically that they wanted to hedge their portfolios abroad. So there's been a massive amount of outflow of funds from South Africa externally, such that our net investment position has actually turned negative for the first time in a hell of a long time. In other words, that means that we earn more interest from external investments than we are paying out to the rest of the world. Now, that in itself is quite a significant change, but it also tells you that there has been a substantial shift of funds abroad. Now, there's been that is a material event that has taken place, and it's taken place because of a regulatory change. It was made that much worse by the fact that we were grey listed, and the grey listing in and of itself only went to enhance South Africa's risk profile. So, to Peter's comment on the current account, it is a valid question, especially in the context of all these portfolio flows that have shifted out of the country. But just remember that once these fund managers have taken their fill of what they're prepared to take out the country, that effect starts to dissipate. And we think that a lot of them have gone a long way already. So there's a tremendous amount that's flown out of the country. I'm not saying it's all done, but I'm saying the lion's share is probably done. And what we will probably experience going forward is slightly less of that. And if we just stabilize on commodity prices, at least in the next 6 to 9 months, in other words, they don't collapse much further because we're in this Goldilocks sort of state, yet the South African economy goes into recession, that current account doesn't need to go into a deep deficit. It can probably still be funded through our attractive high interest rates and our undervaluation on JSE stocks. So that can balance the whole situation out such that we don't get a crisis in the rand just yet. But it is something to be afraid of and something to be concerned of going forward. That perhaps is more of an interesting story for 2024, when we potentially do see a fallover situation for the US and the rest of the world. You do see commodity prices coming under pressure. And you do see a dislocation, especially of your high risk investment destination. So again, like I said, there's a potential window of opportunity now, between now and the end of the year, for the rand to strengthen as we start drifting into 24, and the patience around the US business cycle gradually results in some of that data weakening. The picture changes, and we may have to deal with another bout or two of volatility in the rand, which may feel a little bit uncomfortable.
I just want to quickly chip into the rand volatility there. So if you go back historically, I don't want to talk about cyclical stuff on the rand, but August generally for the rand over the past 20 odd years, like 17 out of the past 20 years, the rand has weakened in August. Somewhere in August, feels like this year we've just got it right at the beginning of August. But generally, cyclically, emerging markets, the rand is weak in August. And that's a function probably of loss of the summer holidays in the Northern Hemisphere. We've seen clients that's got offices abroad that they shut down, like South Africa shuts down in December, they shut down in August. They take their big summer holiday. So liquidity dries up, people don't want to take on risk. So they just somewhere in August, they just de-risk themselves. It's like there's an old slogan says, sell in May and go away. It feels like in currencies, it's get rid of the currencies in August and go away, and we'll reposition ourselves in September and October and whatever. So it's part of the cyclical thing that we see in the currency. We've just seen it much earlier this year. We've seen it very aggressive. But it's part of the cyclical volatility of the currency. That's what I'm going to just end off with.
There is some sense to that, Vichard, not just for the reasons that you've mentioned, but also because retailers at this point of the year also do a lot of their purchasing for the summer period, the December summer period. So retailers are stocking up on new seasonal stuff that is going to be consumed through the summer. So there is oftentimes a slight rise in the demand for imports around about this time. And you're quite right, it happens when liquidity is lower due to the Northern Hemisphere summer holidays.
I'll throw in a last comment. I started in the markets in 1983. That's 40 years ago. We had volatility then. We have volatility now. And in 40 years from now, we'll still have volatility. That's why there's products in the market that you can hedge yourself, protect yourself, and manage that volatility. And I think that's what really is the question. What should I do?
Well, on that wise note, I think next time we might need an hour to get through everything. But thank you so much for joining us. I hope it provided some useful insight into the next 6 months to a year. It's not going to be an easy ride, I think. It's like you said, there's always going to be volatility, and there's some definite events that's going to come around now, throwing some extra volatility into the market. So all the best, and we will chat soon.
Thanks, everybody. Cheers.